Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. We've explored in the past how Tesla may fare in a recession and run through various scenarios. Now it looks very likely a recession may be just around the corner. Or are we in it already? I can't tell. Perhaps I have to turn on some mainstream media to find out sometime. We also have a better idea now of the causes of the recession, so we can perhaps try and identify what Tesla will be like during this market downturn. Some people like to tell me how much consumers will struggle to spend in excess of $60,000 on a vehicle in a market crash. I thought we could explore some of the scenarios that we may expect and see what difference it may make to Tesla, how Tesla might handle it, and how it may also affect the competition. I think rather than just analyze a cliche recession, if there is such a thing, we'll just try and explore it best as possible in how inflation, debt, and interest are influencing the economy. What exactly is happening then? Inflation is kicking in globally. Personally, I think the main cause for inflation is due to all the government spending. Supply chain issues obviously aren't helping either. Shipping prices are still through the roof and thus still have to be felt somewhere along the supply chain. But the people who printed all that money will never take any blame. But this wasn't some bubble that popped and left everyone broke like the GFC. We aren't going to witness something like a potential crypto bubble this time to pop and cause the recession. No, it would appear the governments likely did this one all by themselves. When inflation runs high, the number one move with monetary policy is increasing interest rates. That's right, that's how you break the back of inflation. You increase rates. If we look back historically and want to talk about high inflation, then it's hard not to bring up the start of the 80s. Inflation hit a peak of 13.5% in 1981. Although that does seem higher than the inflation we have today, it was not measured quite the same. And today's CPI figures have a bit of fat trimmed them compared back to 40 years ago. I think that inflation was still a result of coming off the gold standard 10 years prior, and then of course the oil crisis on top of that. It was extreme times. Either way, that was a big figure, and Paul Volcker, the federal chairman at the time, rose rates as high as around 20%. Wow, imagine if we had rates at 20% today. How long would you last on your mortgage payments before you had to default? Does this mean we now have to brace ourselves for rate rises this high? No, the world's changed since. We are an even larger debt-based society. We've been managing monetary policy thus far and society has remained intact. Can we manage it this time too? The GFC was a really scary time. It took a long time to get out of and a lot of people lost their homes and life savings. We don't want to go through that again. Due to all this debt now, and not just from the GFC bailouts, but of course the COVID spending too, in fact, especially the COVID spending, this means that the Fed don't have as strong control over monetary policy. Their powers are somewhat limited. The less debt to GDP ratio the government has, then the more effective monetary policy can be. But with debt where it is today, well, they're running out of juice. And it's not just the government, but the population too, all living on debt, depending on low rates. And here we are today, the dilemma the Fed face, a big fire and just a small fire extinguisher. The Fed need to use what they have as effectively as possible, using scare tactics to reverse spending, as if this gets more out of control, the Fed are going to be more limited as to what they can do. Meanwhile, this inflation is wiping out people's life savings. Biden needs to stand confident and look like he has a control on inflation, yet at the same time, he can't totally kill the markets either. The way I see it currently is there is a balance now between the level of inflation we're going to see and the level of recession we will see, and I really don't know what will happen. The best trading strategy might be to straddle right now, which is when you have puts and calls. Expect volatility, but in which direction we aren't sure. I think it's possible we might still see a further 15% correction in the market to around pre-COVID level, with an average S&P PEs closer to 15 compared to 20. On the other hand, the markets could go up another 50% for all we know before they actually crash, and we see a real rout rather than just a correction. Could the markets really go up? Well, in a sense, although it would possibly be more the dollar going down, or inflating, or even hyperinflating. I am of the belief that this will be more likely to happen. I don't think they have that much of a chance keeping a lid on inflation. Historically, over the last couple of decades, we see in each recession that they can only raise the rates so high each time. This is due to the fact that governments also have to pay interest on their national debts. Governments only have so much actual income to cover this interest. Their only other way to pay for it is borrow more. Now, if you're borrowing to pay interest on your debt, then the currency is going to keep inflating. It might be that this time governments have borrowed so much that they're not able to raise the interest rates to a high enough level to break the inflation, which is going to be tough, hence perhaps economic scare tactics. To get out of this, at least what will help would be some real leadership right now. The governments should be doing everything they can to sort out supply chains and reduce the cost of oil inflation isn't just about interest rates, but allowing commerce to flow freely without bottlenecks that can create the inflation. Alright, now let's look at historic auto sales during similar times to see if we can gather how bad this might be for Tesla and perhaps the auto industry as a whole. Now, in the Great Recession, in the US, auto sales dropped to as low as 10 million a year in 2009, down from 16 million in 2007. That's a big drop. In fact, from 2007, it took around until 2017 until the numbers were up that high again, but it had mostly recovered by 2012. Either way, that is a big drop, but this was a big recession. In fact, a lot of people think the next one we enter will also be some of the ongoing side effects still from the previous global financial crisis. Either way, that's a 40% difference between the high and the low in the space of 2 years for US auto sales. Remember though, this was the mature ICE industry. Tesla is in the rapidly growing EV industry. It's possible that although the market size of autos in general is going to be smaller in a down economy, it's also possible that the EV industry itself is still growing. Possible? Well, I hope very likely indeed. Therefore, Tesla is still in a growing industry, and likely when the 46 eddies ramp up, Tesla will also be back to a growing market share in the growing industry. And what about the competition? Well, if they lose demand, it means they may have to drop prices, which mean they will lose even more dollars on every EV they sell. But I do think the EV industry should still grow. I also think supply of ICE will dwindle anyway, and consumers will have less ICE available to them to purchase. Yeah, the legacy autos might struggle a bit through this recession. We'll go into more detail on that in another video. In the past, luxury auto brands that sell a lot more vehicles than Tesla have made it through many recessions, like Mercedes and BMW. But Tesla's still in a growing industry and has a lot more profit margin than those other companies, not to mention none of the debt. I really can't express enough how much a better position Tesla is in than any other auto company. Over that same period, average car prices in the US went from a high of $28,000 in 2008 to a low of $23,000 in 2010, not adjusted for inflation, but an 18% drop in price. But it did recover quickly. One thing about Tesla though is that due to the vertical integration and level of automation, along with generating its own energy in the factories, as a result the business model is not so susceptible to inflation when compared to others. It also results in Tesla having larger margins, which are a powerful weapon to use if demand is looking weaker. So judging by what happened in the last recession, demand for autos could be down as much as 40%, and prices for autos could be down a further 18%. Now that doesn't mean prices of vehicles will be dropping, more so that the consumers are moving to lower cost models. It would be great if Tesla could educate the consumer base better on the true cost of ownership of a Tesla relative to an ICE vehicle. Then it may change the consumer perception that Teslas are better value than people realize, even better value than the equivalent ICE. Well, you know, only if Tesla needed the extra demand. I think Tesla might be alright in a recession. People will still need to buy cars, and in my opinion, Tesla is the most likely to be the last one standing, if it ever came to that. As in, Tesla could outlast the worst recessions longer than any of them. Tesla has so many tools left to get through a recession, and I believe when it comes out the other side, it will be leaner and stronger, and there may be fewer competitors around. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.